Good morning. It's Monday, October 7th. We got a great group of guys here, and we're going to be talking about energy, power, and financials. All the things I like to talk about. So, to get us going here, we got our buddy Robert Marson talking about Constellation Energy and how he believes it might be a little bit on the overhyped side. What do you got?
Well, let me start with full disclosure. I've done this a long time, and I don't think I've ever owned an electric utility. So I am not. I've analyzed thousands of businesses and transactions, but never looked at an electric utility in my life because the industry is just too boring for me. There's not enough secular revenue. There has not been enough secular revenue growth. And you know what? Since 1982, when I started, I've been right on the fundamentals. In general, the industry has been, a sleepy, underperforming place to be. So I don't feel like I missed anything. But with all the hype around, you got to buy the power related stocks. I figured I'd take a look at Constellation Energy and see what I was missing. And my inclination as a deep value guy or a valuation sensitive, numbers driven investor, not story driven investor, when he sees something like this, he has to look at it and say, what's up here? So this is just the company's stock price in white. It's up on a parabolic spike. The earnings estimates for the last year to 2 years have been going up quite a bit. This company was spun out of another electric utility with its collection of nuclear assets representing 2/3 or 3/4 of its capacity. And the earnings estimates went up a lot. Despite that, the revenue for the out years in 25 and 26 has been flat for 2 years. So they're creating a significant amount of margin expansion and earnings leverage with very modest revenue growth. In fact, in 15, I think they did around 21 billion, and they're doing 24 billion this year, I guess, 23 to 24 billion. So it hasn't delivered the outlook for or the actual sales growth. This chart shows what everybody's excited about, okay? And when you're dealing with power, obviously when you're dealing with any product, we have price and units, right? That's how companies generate revenues. And these guys, they don't have a lot of units because it's very expensive. It takes a long time. And nobody kind of saw the AI boom coming for capacity 5 years ago. And it takes 5 years to put a lot of capacity in today. There's all kinds of bottlenecks in hardware, approvals, interconnections to the grid. It's a mess trying to grow the capacity for these companies. So there has been very decent, healthy price increases in this company's income statement, showing now and showing in the next 2-3 year period, because these guys they do determine a fair amount of price in advance with contracts. So there is visibility here to some significant growth in the next 3 or 4 years from pricing and perhaps from co-location. That's where you put a facility right next to a data center. You're sort of behind the meter and you just feed the data center. And this company is thought to be a leader in that, but that's many years out. So the stock's gone up 5 times since it was spun out. It trades for 23 times EBITDA, trades for 30 times earnings. There's mid to high single digit revenue growth put into the model right now, which is underwhelming. The management is willing to talk about 10% secular earnings per share growth, and that's solid. That's actually very good for a utility if they deliver on that. And I would think they should be able to do that. But do you want to pay, 23 times EBITDA and 30 times earnings for 10% compound earnings growth. It seems a little rich to me. So the story is better than I thought. I understand why people get all excited about it because they stand back and they say, look, there's going to be power shortages for years to come. And perhaps these guys are going to make a lot more money in the next 3 years than we think because they over earned this year quite a bit. The earnings estimate revision, they started the year at a less than $6 estimate, and they're making $9. So people want to project that linearly into the future, I think. And I would buy management's guidance of 10%. So the number came up to $9 this year. This is not an NVIDIA. They're not growing 100, 200, 300% on the top line. They're not raising ASPs, by a factor of 10, the way NVIDIA did with its positive mix shift. And they're very much restricted on how quickly they could add unit growth capacity over the next few years. So this would be one. I am stalking it as a short candidate after this latest buying panic.
And the buying panic came from an announcement that they would reopen 3 Mile Island, correct? And then the market got excited.
Yeah, that's interesting. I asked a big shareholder about that, and he's a serious fundamentalist, and he didn't have the numbers right. So that's what people do. They might want to not know the numbers, but yes, that's totally right. It added $15 billion in market value the day they announced this. Unit 1 at 3 Mile Island. They don't own the other two. They're being decommissioned. They can't. They don't even have the right to them. They're in the business of now applying for a loan guarantee from the government to upgrade that and put that back in, recommission it. And we definitely need it. But according to unofficial sources, people are guesstimating. I estimated it was $600 million in revenue for 860 megawatts of capacity. And I use the current pricing for data centers in Pennsylvania, but it looks like it was, closer to $800 million. So like 10 cents. So it's the company said it was worth 16 billion over 20 years, which means it's an $800 million annual revenue stream. And that's excellent. That's a nice deal. But, on a $23 billion company, but do you pay 20 times or 25 times sales for that in the valuation when you increase the value so much, right? The valuation so much. The company trades for 5 times sales, which is on the high side. Why would anybody want to add pay 20 times sales for a chunk of solid business from an excellent customer, Microsoft? But why would, when the business itself is only worth 4 to 5, why would anybody pay 20 times for that block of incremental revenues? That to me is a sign that there's a buying panic. Correct.
Yeah. So I guess it's kind of just a supply and demand issue in the sense that the buy side's clearly decided that NVIDIA and the IPPs are their preferred way to play this, the AI, build out in essence. Usually when you see that, there's not enough paper, people chase and multiples go up. You think it's as fair as that?
Yeah, but again, they do have these power auctions in their biggest grid, the JPM grid, and I showed that chart last. And there's rumors that the next auction every 6 months they price power out. The grid buys power from them, capacity for power, and they've paid $20 a megawatt day. A couple of years ago, they paid 270, I think. 200 last July, and that added $1 a share in earnings. And that the rumor is that's going to go to $6.95 per day in the next auction to reflect the shortage. And if that's true, 2 things are going to happen. They're going to add $3 in earnings, so the $10 run rate will become $13, which might be priced in at $300 stock. I think it would be. But it's also going to raise power prices to consumers in that area, the Middle Atlantic grid, by 20% in a year. So there's going to be pushback from the retail, and I would think consumer and the government entities that regulate electricity pricing and investment, if there's such a major step function increase in pricing for retail consumers, because these big rich data center companies like Amazon and Microsoft and Facebook are coming in and paying anything they can afford for power. So
Yeah. Go ahead.
there's 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 there wouldn't be it wouldn't there's no free pass with raising your prices that aggressively with the regulators, in my opinion, but we'll see what happens.
Yeah, I would add that, the idea that we're going to make people pay more for electricity and then maybe for a purpose that could take their job won't be that politically popular in the out years as well. That's not today, but that is something you could see easily through down the road. So,
Now,
all right,
now
go ahead.
I'm not shorting the stock. I've shorted enough new highs with strong momentum to know that if you do that, you have to use very tight stops or don't do it at all. But I am going to watch it, and if I believe the market is going to correct, I think there's a lot of air under this chart, and it already had a very nice correction of a couple of months ago. It's definitely vulnerable to any kind of pullback should there be a kink in the story from whatever source.
Yeah, I mean, it was a flat stock from March until this last announcement with the 3 Mile Island. So, the market was kind of just chopping it around. And so maybe you're right. Maybe they're overvaluing this in the near term. But all right, we're going to move on. More energy. Where Bob Morris has a view on Viper Energy and an update on a merger.
Yep, thanks. So last week we bought some Viper, symbol VNOM, and it did reach an all-time high last week. We didn't buy it at the all-time high, but this is a unique company on playing the upside to oil prices. And what they do is they own and purchase mineral and royalty interests. What that means is they take a percentage of the revenue off the top, and they don't pay any of the operating or capital costs. It's pure percentage anywhere from 1.1% to 5.4% of the total revenue. So they're not exposed to any cost inflation. They're just taking a straight cut of the revenue from the oil and gas wells that others operate. The important thing here, too, is this is classified as a corporation, so there are no K-1 filings. But this company was originally spun out from Diamondback Energy, FANG, which we own and we like very much. And it's essentially the same management as FANG. And in fact, FANG insiders own nearly 1/4 of the shares of Viper. Now, what's interesting here is it pays a very high dividend. There's a base dividend of $1.20 per share, which alone would be 2.4% yield at today's price. And they actually increased that dividend last quarter. But they also paid a variable dividend of 34 cents per share in the second quarter, which brings the annualized yield up to 5.1%. And I think that that's something that we'll continue to see here going forward. But they own about 32,000 net royalty acres, of which 50% is operated by Diamondback. And less than 35% of this acreage is developed. And why that's important is that, one, that's the acreage where they get a higher royalty of closer to 5.4% versus 1.1% on a lot of the other operated properties, which are operated by people like Exxon and Chevron and Occidental Petroleum. And second, what this does is it gives us very clear visibility on the production growth and development going forward. And we know that from covering Diamondback and what their plans are going forward. And as you know, Diamondback's our favorite Permian Basin pure play in the E&P sector. Also, Diamondback just last month closed this acquisition of privately held Endeavor. And we think that there will be drop downs from the Endeavor assets into Viper. So that's a plus as far as growing their cash flow and production going forward. If we look at this thing here, what I point out too is it's $75 per barrel WTI, which is close to what we're at today. The midpoint of Viper's production guidance, and then paying out 75% of their free cash flow to shareholders. That again provides a dividend yield of close to 5.1%, even with this recent run up in the stock price. And the one thing that management said is they didn't buy back any shares in the second quarter. And they said that their preference for the free cash flow is, one, the base dividend, two, a variable dividend, and three, share buybacks, but they're not doing any share buybacks. In fact, they stated that they're currently comfortable with the high distribution model. In other words, paying out up to 75% or minimum 75% of free cash flow out as a base and variable dividend as opposed to share buybacks, which interestingly is the opposite of Diamondback. Diamondback itself is now, they prefer share buybacks. So as we look at this thing, the other thing is that it has protection on the downside of oil prices, but gives us great exposure to further upside. Again, they're not incurring into the capital operating costs on these assets, but on a large portion of that production, they have hedges in the form of either $55 WTI puts or collars with a floor of 55 and a ceiling of nearly $94 per share. So while we're getting a very strong dividend here, if the turmoil in the Middle East continues and oil prices continue to climb here, which is hard to predict, this is one of the pure, easier way or safer ways of play that upside in oil prices. So again, we bought the stock last week. We don't have a full position. We're watching it here to add to that position, depending on market conditions, what happens here. In the meantime, as far as that variable dividend on top of the base dividend, the company reports their third quarter earnings on November 5th. So we should hear something on that at that date. Now, separately this morning, we had some news with the Canadian Natural Resources and Chevron. We own both of those names. And Canadian Natural Resources announced they're buying $6.5 billion worth of assets in Canada from Chevron. Bottom line, we view this as a positive for both companies, more so for CNQ than Chevron. For Chevron, it gives them cash on the balance sheet, which they can use for acquisitions and other purposes. And remember, we're waiting to see if they win the arbitration here on buying Hess versus Exxon, saying that they have a first right of refusal. But again, it fortifies the balance sheet, which we view as positive. So for CNQ, they're just adding to their interest in the Athabasca Oil Sands project, which is their best asset, in my opinion. And this takes their interest from 70 to 90%. So basically, they're just getting incremental production and cash flow without any add to overhead or anything else. It's just pure additional incremental interest at a very good price. And these are assets that have no production decline because they're oil sands. You just dig out of the ground for the next 40, 50 years. And the break-even oil price on these assets is below $20 a barrel WTI. So these are very good assets, strong free cash flow from these assets. They bought some other assets in the Duvernay area too, which are very good in around existing assets they have. So basically just fortifying their existing position that comes at a very good price and is very synergistic for them. At the same time, they announced a 7% increase in their dividend. And again, this is one of the highest dividend yielding names in the E&P sector, another reason we own the stock. But this is 25 consecutive years that this company's raised a dividend, even raised it when oil went to below $20 a barrel several years ago. So we view this as a strong positive for CNQ, gives them additional firepower and free cash flow and ability to continue to increase that dividend, and is at a good valuation. So we continue to continue like CNQ. And again, it's more of a positive than it is for Chevron, but we like it for Chevron too.
Let me ask you a question. So Viper's obviously had a really nice run here. If we go to $94 oil, because obviously they're collared there, so it doesn't, I guess could be higher as well. But what's the incremental cash flow that then would be paid out to guys, let's say over the next, 6 months, 9 months, 12 months? Just do it a year, actually. So if we got to a scenario where we're averaging in the 90s oil, what would the incremental cash flow payout be to them for that variable dividend?
Yeah, I'm looking at the presentation here to see it. I didn't run it at that high level, but if we go to,
I'm just curious about what their sensitivity is on a cash flow basis, or what you think the stock reaction would be other than directionally up, obviously.
Yeah, so at $75 oil, the yield's 8.2%. At 85, it's 9.3. So you're looking at about 10.5%. Total payout yield at $95 oil versus 8.2% at $75 oil. So, as far as the dividend, it could be, if they pay out 75% of free cash flow, all as dividends, you're looking at perhaps another 20% upside or higher than 20% increase in the dividend at the $95 per barrel oil. So then you're looking at a yield of, something closer to 6.3%.
Okay, so you think it could be we get into that regime, that's like a $60, $60+ stock, basically.
Oh yes, definitely.
Okay. All right. Well, that's good.
And we have had a nice bounce in oil. So if you had a little kahunas and you wanted to buy energy stocks last week, a week and a half ago when oil was 67, we're up into the mid 70s now. You know,
Yeah, at that point, given the impact on the economy, everybody's buying energy and selling everything else.
Right. Well, it was hard to it was hard to find people, buying energy stocks at the bottom a couple of weeks ago in my book. But.
Hey, I pitched on this show long June 26th oil futures sometime in early September or August, and I still own those. I think that one thing that's probably not talked about enough in the general market is that energy has an implied negative correlation to the markets. So being long these assets, especially the kind that Bob and you I like in general, has nice cash flow characteristics, nice dividend yield characteristics. But there's also this thing, like if you remember 22, oil stocks were great, the rest of the market was terrible. So you have an embedded value in the sense that if we go to $150 crude, it's going to destroy the economy, but it's not going to destroy energy stocks, right? So it's a way of having a short position in a long position is one of the things I think about that's not talked about enough, in my opinion.
Well, there's a lot of sectors in energy, and I screwed up last weekend not saying this on my call when I was talking about energy in general and Weatherford, and that is the MLPs and the midstream guys are at the highs. The major oil companies, Bob, are off a little bit, but they didn't get slaughtered, correct? The Exxons and Chevrons, right? So it's not like they followed oil down 25% from their 20% from the high. But what did get crushed and became very cheap were the oil service stocks. So Schlumberger, Halliburton, all these, Select Water is a small company that I follow. They came down, 20, 30, 40% and from their peaks, and they got down to 4 to 5 times EBITDA. So if you believe that oil is going to recover to $80, $85, $90 and stay there, the oil service stocks are the way, in my opinion, to play the sustainable recovery in oil. If these guys provide equipment and services for essentially something that's almost manufactured now, especially in the shale plays, and if they provided goods and services with their fundamentals and financials to any other business, they would not be a 4 times. Machinery and service and equipment companies and systems companies trade for 12, 15 times EBITDA today. So if you believe the EBITDA is normal for these businesses, they're really, really cheap compared to any industrial company, in my opinion.
Yeah, you have to be careful. The reason they're so cheap is that all these E&Ps and integrateds aren't going to ramp activity. That's why they talk about returning so much free cash flow to shareholders and why they're all trying to basically hold production flat here. So as we talked about last quarter, companies like Diamondback getting 20% more production per rig, per lateral foot, as these companies continue to put up efficiency gains, getting more with the same or less equipment. And we've seen the U.S. rig count continue to sort of slide down here. So the problem for the oil field service companies, the reason they're so cheap, is all the E&Ps and integrateds are maintaining their discipline of saying, look, we're going to hold production flat. We're not going to ramp up. We're not going to add activity. And in fact, we're seeing these efficiency gains where we're getting more for the equipment that we're using. And we're going to continue to return all that excess cash to shareholders in the form of share buybacks or dividends. So we haven't seen that turn yet. We've seen the E&Ps and integrateds maintain that discipline. We haven't seen anybody yet, despite Trump saying if he's elected, he's going to push this drill, baby, drill. Nobody's going to go out there and start adding rigs or start ramping up activity and try to grow production like these companies did for 3 decades that got them in trouble. So that's the thing you've got. That's why the service names are cheap. Why you've got to be careful here. For those guys to work, you've got to have some uptick in activity. You got to have some tightness in the market for them to have some pricing power, and we're not there today.
Yeah, well, that's why they're down a lot and 4 times EBITDA. If they were setting the world on fire, and if you want to buy Weatherford at 130, the 52-week high when business is good next year, Bob, be my guest. I'll sell it to you because I'm in at 84.
And I would note that that's one thing that probably isn't talked about enough. I mean, it's obvious to Bob, who's day in and day out in the oil patch, but we've got flat production in the U.S. for over a year now. Do you think that can be ramped, Bob, or do you think that's kind of like, like Art Berman argues, like the ultimate recoveries in the Permian are down 50% from 2018? Are we stalling out, or is that a actual choice by the E&Ps?
Yeah. Actually, oil's up a little bit. I mean, we're at 13.2 million barrels a day total production now. At the beginning of, 2 years ago, December 2022, we were at 12.1 million barrels per day. And so we've sort of been on this incline here, slow incline over the past 3 years. And that's all just because of the efficiency gains. And so, that's one of the things that OPEC is worried about is that the U.S. oil production continues to creep up. Like I said, in 2 years, we've gone from 12.1 to 13.2 million barrels per day of oil production. There are some companies that are slightly increasing their production, like Oxy, like Pioneer within Exxon now. And so, I'm sorry, the original question was what again, Ben?
I think over the last year, though, it's kind of stalled. I know that on the 2-year basis it's up, but I think it's starting to flatline. There's been a major deceleration in the improvement, essentially.
Yeah, year to date, it's about flat.
Yeah,
you're right. Year to date, it's flat. And I think a lot of that is just companies pausing to integrate a lot of this M&A. And so when you have acquisitions, people sort of slow down, especially the companies being acquired, and wait till they're part of the new company to begin to start stepping up things again. So I think you'll continue to see, especially with these efficiency gains, as companies integrate these acquisitions, you'll continue to see that slow creep in U.S. oil production. We're not going down.
Yeah. Okay. All right. Well,
I just want to say that earlier I said we were going to crown Bob the king of our trading group because I thought energy was going to be in the forefront of everybody's mind, and I also said that October would probably have some military action. So I bought the November crude futures, if you recall correctly. We talked about that as well.
Yeah, that was fantastic. You get first prize for the trade of the month or two.
Charlie's quite the tourist. All right, Charlie, let's talk about your main lane, which is financials and interest rates. What do you got for us today?
Well, I want to pick up on something that I alluded to on Thursday's roundtable, and that was what we were at a sort of a trend change in the rate structure. And I thought that would impact how you play, certain financial stocks. And so the bottom line is that, I noted that we had been making lower highs in yields across the yield curve since April 25th of this year, and thought that we were coming to a point where, all of a sudden we were going to make a higher high this month versus the previous month. And we did, obviously, on the jobs number. So there's some sort of trend change in rate structures that's taking place. And on Friday, we saw how that played out in the way certain financials traded. So there are three things that I want to make note of. The first is we saw a move away from the asset-sensitive regionals towards those banks that benefit more from fewer rate cuts and possibly higher rates. So things like JP Morgan and Wells Fargo outperformed other regionals. And even within the regional group, those regionals that are more neutral or less asset sensitive, like M&T Bank or Zions, performed well. So there seems to be a rotation away from those banks that would benefit from multiple rate cuts towards those that benefit from fewer rate cuts. And as well, the unsteepening of the yield curve also was a factor in how certain banks traded. Right. The second observation I want to make is that we did see a very good bid in the lower quality consumer finance companies. Here I'm talking primarily the credit card companies. And the thesis there, I suspect, is that with the strong jobs numbers, we're going to have lower delinquencies and fewer credit issues in the card space. So you saw Synchrony Financial and Bread Financial outperform the other card companies like American Express. I'm not sure I agree with that trade. I still think we're going to have higher delinquencies going into year end. So I'm not on board with that one. And then the third observation is we did get a sell-off in what I call things that need to be financed. And that is because the whole rate structure shifted higher, making affordability a continued problem. And specifically there, I'm talking about, I've been saying you got to sell the home builders like Lennar or D.R. Horton. You got to sell, car companies like CarMax or Carvana or AutoNation. And you got to sell, boat and RVs, companies like Brunswick Corp or Polaris, because I think affordability is a problem. And either these companies are going to have to cut their prices, which means a margin squeeze, or they're going to miss their volume estimates. So I think there's some disappointments on the sales side coming for things that need to be financed. As it relates to banks, we've saw very little loan growth here in the third quarter outside of the card portfolios. But we're not seeing any real growth in purchase mortgages. We're not seeing any real growth in auto finance, in RVs. So while the consumer may be spending for wide-legged jeans, they're not spending for durable goods. And I think that has some implications for the broader economy as well. So I'll stop there, Ben.
So yeah, as you know, right before the Fed, I came on here and said that it was time to short bonds again. And if you look at the June SOFR, it's off 60 basis points since the day of the Fed. I mean, do you think there's an impetus to try and get this curve steepened, to help these banks? Because the flatter it is, it's going to hurt. One of the things you've been talking about is net interest margins, net interest income being weak. Do you think there's a concerted effort on the Fed to get the back end steepened up a little bit, and then you're going to push down the short end, just to protect banks' income generating ability, especially with mortgage rates coming down quite a bit?
Yeah, I mean, as you know, last spring I wrote about, shadow yield curve control, which was an attempt to, I think, juice the economy. But if monetary policy is going to have a successful transmission mechanism, it needs the banking industry to lend. And for the banking industry to want to lend, you have to steepen that yield curve. So yeah, I think there is, put it this way, there's a lot of machinations going on ahead of the presidential election. And even the jobs number on Friday was somewhat suspect because many of the jobs, or most of the jobs, were government jobs. And there's a history of government jobs being created ahead of an election. So I'm curious as to how long that strong jobs data is going to play out as a theme.
And what do you think about the current status of the refi? There's $20 trillion of equity. I looked, there's about $13 trillion of mortgages outstanding, which ironically is about the same amount as the GFC, even though it's 16 years ago. So as a percentage of GDP, it's come down quite a bit. But, the housing markets continue to rally. So there's a huge latent amount of equity sitting in these homes. Do you think that that has to be one of the biggest cases for the bull case? If you're a bull here, the rates coming down and people being able to tap that equity should be like a real positive, right? Rocket Mortgages has traded well recently as an example.
Yeah, there's no question we have seen a spurt in the refi index. We've had an improvement in the purchase mortgage index, but it's off such low levels. I mean, we're still back to 2015 levels in mortgage applications, even despite the 4 or 5 weeks of improvement. The refi index is where we're getting most of the activity. And I forget the name that you had recommended.
Better Financial.
Yeah, Better Financial. And that's probably the better way to play it. And you're right. If we can, do some cash out refis, which I'm not sure that's what we're seeing yet, but if we can do cash out refis, that would put money back in consumers' pockets to spend. I think most of the refis we're seeing now, Ben, are not cash out though.
Okay.
So we'll see.
And why is that? Is that because the banks don't want to give out cash? They just want to say, hey, we'll change the liability structure versus why do you think that is?
I think the consumer is trying to just lower their monthly costs, not trying to take out cash against the equity in their homes. Now, we may get to the point where they say, listen, I've got a lot of equity. I'd like some extra cash. But right now, all they're trying to do is lower their monthly payments. So there is a big difference between refis and cash out refis, is what I'm saying.
Yeah, absolutely. No question. All right. You got anything else, or is that it for today?
That's it for today.
It for today for me.
All right, guys. Well, thanks for joining us on Beats Roundtable. I'm Ben Bryce, joined by Robert Marson, Bob Morris, and our favorite Charlie Peabody. We will see you tomorrow.
Thanks, guys.